Welcome to part 4 of our series on the credit union sector, some reform points to ponder. Again, I'd like to start with the opinion disclaimer that the views expressed in this presentation reflect my views and my views only. We started off the series examining corporate governance issues, then modernization. We looked at sector growth and marketing, and we closed off the discussion on addressing the issue of institutional capital. So let's start off at the beginning with some basic accounting equations and relationships. Of course, assets are equal to liabilities and shareholders' equity, which are also referred to as capital. So if you minus liabilities from assets, that leaves you with shareholders' equity or capital. Profits increase shareholders' equity. Conversely, losses reduce shareholders' equity. Expenses are justified when revenues generated from those expenses exceed the cost of the expenses. And dividends reduce shareholders' equity. So let's address the issue of institutional capital as defined by the World Council of Credit Unions, looking at their Peirce ratios. Institutional capital is defined as all legal and non-distributable reserves, capital donations, and the portion of the current year's surplus that will be retained as legal or non-distributable reserves. These reserves are not expended, and no member may present an individual claim on them. So the question you may ask is, why is institutional capital important? According to WOCU, institutional capital is the best indicator of profitability within a credit union. Static or declining growth in institutional capital indicates some problems with earnings. Conversely, one of the best signs of success of a robust credit union is a trending upwards of its institutional capital. Looking at the institutional capital divided by total assets ratio, it's a simple ratio dividing institutional capital by total assets, A over B, and the goal is to maintain a minimum 10% ratio. If we go into some more details and look at the net capital ratio defined by Peirce, it goes into a little more detail. To the institutional capital, you add the allowances for risk assets, and then from that, you minus all loans which are be delinquent over 12 months, and you also minus 35% of the loans which are delinquent between 1 month and 12 months. Also minus will be any losses to be liquidated. So when you have that net figure, you divide that by total assets, and the expectation as well is that the ratio would be 10%. So in summary, institutional capital represents all the legal reserves and surplus created from the operations of the credit union, while net institutional capital subtracts the losses and the delinquent loan accounts, a portion of it in 1 to 12 months and 100% over 12 months, and any liquidations to be written off to derive the institutional capital ratio, which is expected to be 10%. So what does this mean? In terms of increasing institutional capital is increased by profits, by making good loans, by acquiring productive assets at fair market value, which generate positive returns, by reducing expenses without a negative impact on revenues, by generating new revenue streams which exceed the cost of achieving those streams. And what causes a decline in institutional capital? First off would be losses, bad loans, dividends, acquiring non-productive assets, incurring expenses which exceed the revenues to be derived, paying more for an asset than its worth, which may lead to losses down the road or write-offs, overruns on capital projects, cutting loan interest rates if this is not offset by an increase in loan volumes, and paying higher rates on member deposits if that rate increase is not offset by increased lending activity at higher rates or increased investment activity at better returns. Which leads me now to some institutional capital suggestions. Number one, accounting for dividends. At present, institutional capital calculations are currently made using dividends paid and not dividends payable for a particular year. So, example, the institutional capital for 2020 financial year uses dividends paid in 2020 in its calculation. but the dividends paid in 2020 would reflect the dividends from the financial year ending 2019, not the financial year of 2020. The challenge has been in the past that, of course, the 2020 dividend recommended by the board has to be approved by the annual general meeting before it is applied. The recommendation here is that the credit union's institutional capital should be determined using that recommended dividend of the board, given that the dividend is being recommended is a result of the net surplus of the year under consideration. Disclosure. Credit unions should indicate clearly what is the institutional capital ratio that exists and whether the 10% target is being maintained. Perhaps dividends should only be considered after achieving that 10% ratio figure, unless the organization has clearly defined and outlined a strategy to achieve the 10%, and that is included in its annual budget. In its annual report, the board should indicate very clearly the impact on institutional capital of any recommendation that is being made to the AGM in terms of dividend payment. Stress tests. Of course, we are all experiencing the impact of the global pandemic with COVID 19, and that has caused certain stresses to occur for many types of businesses, including credit unions. In terms of its membership, may have difficulty servicing loans. Loans may have to be furloughed for several reasons because of payment issues. Additionally, the movement was previously impacted by institutional failures in the past. Therefore, it is prudent that credit unions conduct regular stress tests to ensure that they can withstand changes in the financial environment that may occur from time to time. Larger credit unions may conduct this test on a biennial basis every 2 years, and it is recommended that other credit unions should be required to do so every 3 to 5 years. And finally, I'd like to address the issue of permanent shares. Permanent shares are a good idea for credit unions because they are not withdrawable, but however, they should be able to be transferred between members. And because of its permanency, it should be included as part of the credit union's institutional capital. Because of its nature, it may not be used for collateral purposes because of limits in terms of transferability of the asset. So it's all about finding the right balance between credit risk and expected returns, balance between the members' expectations for dividend payments and increasing retained earnings, which increase institutional capital, balance between expenditure which may be wanted or desired versus the impact on institutional capital, balancing your loan portfolio so all the eggs are not in one basket or at risk in terms of reliance on particular industries or sectors, balancing your investment portfolio for similar reasons so that you spread the investment risk across a wide range of safe investments. So this concludes the presentation series. And as usual, your comments and feedback are welcome. Let's help to move the reform agenda along. Thank you for viewing and sharing this series.